Hi, it's Greg Goernert, Vice President and Senior Investment Advisor of Canaccord Genuity Wealth Management and Goernert Wealth Management. Now, we're here to help you make sense out of your financial lives. Now, to help you do that today, I'm going to be joined by Canaccord Genuity North American Equity Strategist Martin Roberge to talk about his outlook for 2021. Welcome, Martin. How are you?
I'm good, and thanks for having me.
You're very welcome, Martin. Thanks for joining me. You just put out a great piece about your outlook for 2021. First off, you've got a point about the global economy being a stimuli-dependent recovery. Can you talk a little bit about that, please?
Yeah, it's like there's a pretty good chance that we will be enjoying a smooth recovery in 2021, but there will be fits and parts, and in the first half of the year, we're going to have to deal with those lockdowns. And there's a pre-vaccine risk whereby the global economy will probably lose a bit of momentum, so that the governments, because the central banks are basically at the zero bound, rates are at zero, so the governments will probably need to deliver another relief, like a COVID-19 relief bill that will provide a bridge until the vaccines our vaccination gets the economy going in the second half of the year. So that little bridge is the stimulus that we need to make sure that we start, or we get into the second half of the year and we reaccelerate, because right now we are more stabilizing and we have a little risk of a growth lull because of the curves, the pandemic curves around the world, like, are kind of out of control. So there's pre-vaccine risk again that we need to deal with our fight with some more stimulus from governments.
Yeah. Now, interesting on that, from the Canadian economy point of view, you talked about the Canadian government probably posting the highest deficit to GDP ratio among the developed nations. Now, they've done a lot of backstops, but what do you think is going to happen going forward from their point of view if we do need a second stimuli, a series of stimuli, not only from the U.S. Fed, but here at home in Canada?
Yeah, in Canada, I think we're done, mostly done at the federal level. I think they're done. Like, they already extended the various subsidies to people, to households and small businesses until the end of June, I believe. Mm-hmm. So they've done, like, contrary to the U.S., where it is still spending, but likely coming. In Canada, the Liberals already extended their income backstops until June next year. So I think they're done. I think there could be some tweaking at the provincial level. I think this is where we could see some positive announcements. But that being said, in Canada, we've provided way more stimulus than any other country in the world, and as a result, the labor market has been extremely strong. We've recouped about 2/3 of the jobs that we lost through the pandemic recession in the first half of the year. So we've come a long way back in terms of labor force or labor strength. And I believe that when it comes to Canada, most of the stimulus has been delivered. So I don't think there will be a double dip or anything, or a relapse owing to the amount of money that has been given so far to Canadian households.
Okay, now just switch back to the States, because you've got, we're talking about currencies in general. You've got talk about a convergence towards purchasing power parity, and you made a comment that you believe that deteriorating U.S. fiscal fundamentals are going to drive negative real U.S. rates. Can we talk a little bit about that and what the implication could be for equity positioning?
Yeah. We are facing the second technical breakdown in the U.S. dollar over the last 20 years. Like, the first one was in 2002. And we had a pretty good, actually, it was after the great financial crisis, 2002 till 2003, the US dollar was very weak. Now we're getting the same breakdown and this breakdown is likely going to lower the Canadian, not lower the Canadian, but lower the U.S. dollar to levels we saw earlier in this business cycle. So I'm looking for at least another 4 or 5% decline this year, and probably more in 22, 23. And our reasons for that, first of all, like the global economy is extremely looking good. Historically, the U.S. dollar is a risk off or a defensive currency. So that's number one. Number two, real rates, which is like rates minus inflation, are extremely negative. They're actually the lowest in the world. So it's not very attractive to buy U.S. assets when real rates are so low. So this is going to have an impact on the U.S. dollar. And as you mentioned, the deficit in the U.S., we're talking like if you add together the budget deficit with the trade deficit, it's called the twin deficit. It's going to bottom, according to economists, only in 2023. So, and usually the dollar will follow the direction of the twin deficit, which is down for another 2 years. So I don't want to scare your listeners, but when it comes to the Canadian dollar, we're likely to have a strengthening over the next 2 years. And in terms of equity allocation, obviously you want to be more into the non-U.S. markets, international, what we call international equity.
Yeah. So, just talking on that, if we're looking at a sub 1% world, what does that mean for bonds? And just talk about your asset mix, because I know that in your work that you've done, you've got the 10-year U.S. T-bond yield anchored, around 1%. Where does that put things on that front?
Yeah, usually through a recovery, you will see a pretty sustainable upward push or upward pull in yields as the economy accelerates. This time around, the global economy is still fragile. We're just coming out of a recession, and since rates are already at zero, the central banks cannot stimulate or protect growth by cutting rates. So what they will do this time around is they will protect growth by making sure that rates do not surge if the economy gets too hot. And they will, implement more quantitative easing or bond buying programs to cap or put a ceiling on yields so that higher interest rates do not choke the recovery. Okay, so it's a little bit of financial engineering from central banks, but my hunch is that they're going to do what is needed to make sure that rates stay about where they are, so that the economy, when it speeds up next year, there's no relapse because rates are moving too fast. So that's about that's probably in line also with the fact that the Federal Reserve has said that they're not going to increase rates before 2023. So long rates cannot move up in a significant way if short-term rates are not moving up.
Right. Now, that's a good point. And that segues into the next part, because low rates, weakening U.S. dollar, strengthening economy probably means a couple of things for commodities. So why don't we talk a little bit about commodities? And you've got the year of awakening. Particularly want to talk about copper. Do you want to talk a little gold, a little about oil in particular? Yeah. But why don't we walk down with the breakdown in the U.S. dollar going forward, and the pent-up demand and the type of demand that's coming out of a post-pandemic environment that might be a little bit different than a usual recovery?
Yeah, actually, it's a good point, because we're all talking about a global recovery, but this one has some different tilts. The first one is that it's driven by a recovery in goods consumption. Like, as you know, because of lockdowns, services are not contributing that much to the recovery. So it's really geared towards goods and manufacturing. And as a result, we are facing a situation where companies retailers don't have anything left on their shelves to sell. So we've got to go through what we call an inventory restocking cycle. And usually when this cycle starts, you need raw materials, raw industrials, just to replenish and restock like the inventories. And that's number one. Number two, the global economy is reaccelerating because of China.
Mm-hmm.
So China was the story about 20 years ago. So this recovery may well look more like 2003 to 2008 when we had China being like the bus driver.
Right.
And number three, if you remember last cycle, 2008, 9, 10, the US dollar was pretty strong because we had the Great debt crisis, European sovereign debt crisis. So the US dollar was well bid. So the dollar was not going down. This time around, it is going down. So it's very positive for commodities. So commodities are being fueled by, again, demand for good, demand for restocking, US dollar weakness, and being China-driven, China being a net importer of commodities. So this is the year where probably commodities will surprise by doing better than probably large, the stock market and large cap stocks as well.
Okay, so going through from some of your sector rotation themes, you talked a little bit about growth. You make a distinction between value and value defensives and cyclicals. I want to talk a little bit about that, just in light of a accommodative monetary policy.
Yeah, the market can be broken down in two groups. Okay, growth stocks and value stocks. Growth are like the Apple, the Amazon, the Google. Okay, those companies doing well. Those companies don't need strong economic growth. It's all organic growth, and they have done extremely well over the last several years. Now, since we've seen positive vaccine announcements, we've seen people shifting a little bit away from these stocks into more the value or economy sensitive stocks, because we have got more visibility on growth. People are now shifting, and within value, those economy sensitive stocks, they are what we call value cyclical stocks like energy, materials, industrials. Those are what we call deep cyclicals. And then you have what we say like the defensive stocks like consumer staples, telecoms, REITs, UTs, like what we call the bond proxies. It is where I don't want to go, because I believe that these stocks normally will do well later in the business cycle when there are more economic risk, when the economy slows down. Early in a recovery, you want to go with the momentum or the stocks that are more sensitive to the economic recovery, and this is where you get into the value cyclicals. It doesn't mean you got to sell all your growth stocks, but I think you have to have this year or next year, I would say, like a more balanced portfolio between the growth and the value.
Okay, so hey, why don't you talk a little bit about your favorite high dividend yielder sectors, and then maybe a little bit about your favorite defensive sectors?
Yeah, the favorite income related sectors are those first in what I would say the integrated companies, more so in the U.S. Like those are like the Exxon, Chevron, Oxy. Those have been extremely beaten down because of ESG concerns, lower oil prices. But if I'm right about 2021, oil should normally renormalize as the economy improves, and that should provide a support to those income stocks. And in the U.S., they provide about 6, 7, 8% yield, which is more than what I believe the large cap indexes will do in performance. So I want to go and capture some of the yields in the U.S. or North American integrated companies. And and that would be probably my favorite area. Along with, there are some other areas like U.S. pharmas as well. Pharmaceutical companies in the U.S. have done nothing for a few weeks now, few years. REITs, some REITs that are more cyclicals also could fit the list. But overall, I prefer what we call the cyclical yielders. Yep. Those companies that provide a dividend and those that can grow it as well. In terms of defensive, companies not necessarily providing strong yields, but they are defensive by nature. And the first, obviously, my favorite is the gold sector. Mm-hmm. Gold, we've seen a correction this year. Good year overall, like very good year for the performance of the stocks. But now we just had a 30% correction in the sector.
Well, we needed that, in my mind.
Well, I think it's healthy.
Yeah.
And I think now we've got the conditions for this sector to start a second leg higher. Yeah. And gold is going to keep on being a hedge against the inflation down the road. If I'm right about commodities doing very well next year, well, in 2022, 23, we may have an inflation problem. So gold is a good hedge against rising inflation expectation. And as a result, like I think the correction we just had is a good buying opportunity, especially for those that were not there earlier this year. Okay, exactly. Now you've got your intro point, and that's probably the best defensive idea I have right now.
Okay, and you've also got, and I didn't mean to slide by this, but you've got a $3.75 to $4 copper target per pound going out next year. Yes. That fits in with the whole reacceleration of the economy side. But those are some impressive numbers. We were like $2 not that long ago.
Yeah, I think we hit 220 at the bottom of the cycle, and what we're seeing in copper, in the copper industry, is very unusual. Normally, when you look at commodities such as copper, and inventories are extremely low because there hasn't been much drilling for years. So visible copper inventories in warehouses are very, very low. And normally when they're low, prices are high, okay? And then companies are producing because they want to capture those high prices and cash on those copper prices. And actually we're seeing the opposite. For the first time in a while, copper inventories are low, and companies are not adding to their capex. They're not adding to their production a little bit, but not in a significant way, so that that copper inventories will remain low for at least another year. And if I'm right about that, like we're going to hit the $3.75, $4, which is where we were actually. In the last, I would say probably more than in the last cycle, like the Chinese cycle, like 2003 to 2008, we're going to revisit probably the same price levels that we saw in that cycle. Okay.
Mm-hmm. Well, hey, that's fantastic. I don't want to keep you in long. Thanks again for joining us. That was a great insight, and looking forward to 2021. And as they say, 2020 is hindsight. Thanks very much, Martin.
All right. Bye-bye.
Bye.